Okay, so to calculate cost of equity, remember I already said that, okay, we use three methods to calculate KE, which are capping, dividend model, and Miller and Modigliani model.
Yeah.
Okay, so these are the three methods we can use to calculate KE, and we have discussed capping and dividend model. So let us talk about Miller and Modigliani. Now, for using Miller and Modigliani to calculate, using Miller and Modigliani model to calculate cost of capital, it is based on proposition. That is, Miller and Modigliani, there are three propositions and they are all formulas. Now we have proposition one. Proposition one is talking about value of company or value of business. So it's saying VG is equal to VU plus DT plus DT. That's proposition one. Then proposition two talks about cost of equity. That's proposition two. How did it say it? It says KEG. It is equal to KEU plus KEU minus KD. VD divided by VE, 1 minus T. There, right? So this is the formula for proposition two. Proposition two is the most important one, and the examiner will give the formula. So we just need to learn how and when to use it. Okay, I can move to next slide. Then
Yes, okay.
Okay, so the last proposition, which is proposition three. Proposition three talks about WACC, weighted average cost of capital. It says the WACC of a geared company is equal to the WACC is equal to the WACC of an ungeared company. Okay, then we have 1 minus dt divided by VE plus VD. VDT. Now, so these are the proposition. So let me write this. Where VE, VG, sorry, VG is equal to market value of a geared company. VE is market market value of a market value of an ungeared company. So it's supposed to be VU ungeared.
Okay.
Yes, it's VU.
Okay.
Then D,
DT.
or you call it VD. That is the market.
Is it DT or VD?
No,
Because you know DT.
is V. I will write that one later. I'm coming.
Okay,
That
D.
is market
Okay, D.
market. D is market value of debt.
Okay.
Market value of
Okay.
debt. Then T is tax rates. So DT now means tax rates times market value of debt. That's DT. You get it?
Okay.
Yeah. So it is D times T. Then what else? I'll move to next slide. Then we have KEG. You already know this one. Cost
Mm-hmm. Cost
of
of equity
equity
geared.
of a geared company.
Company.
KEU is cost of equity of an ungeared company. Be familiar with this once. Then cost of debt is still cost of debt. All right. VE, market value of equity. Then another one that we are not familiar with is WACG. This is the WACC, weighted average cost of capital of a geared company. Okay, WACU, that is WACC of an ungeared company. Okay, that's now. So basically, that is, we just have formulas for Miller and Modigliani, and it is expected that we learn how to use the formula and where and how to use each of these formulas, right? Now, so back to the formula, we have WACC of a geared company equals to WACC of an ungeared company. So please just note that WACC of ungeared company, it is equal to KEU. So a company that does not have debt, whatever their cost of equity is, that will be their WACC.
Okay.
Now, this is the reason. You see it here. You have the formula for WACC is what?
That's your KE into bracket VE over VO plus KD into bracket KD 1 minus T over VO plus K KP if there's preference
Okay,
shares.
let's just say, yeah, if there's, so let's go on now. I mean, okay. Now, so um, this is this is the this is the weighted average formula. I mean, we have KEU. Okay, good. Now, what I want to show is that this is the weighted average cost of capital, right? And then I'll say your KE. For example, let's say your KE is 12%. Let's say KE is 12%. Market value of equity is 60 million. The only thing the company has is equity as capital. So total VO2 will be 6 million. There is nothing like debt because the company does not have debt. They are not financed by debt. So you do 60 years, 60 years, 1 year. So times 12. So your WACC still remains 12%. This is the WACC of an ungeared company.
Yeah.
Do you understand? WACC of an ungeared company, which is going to be 12%. And how is it you've seen that because the company does not have debt, so there is nothing we can do about debt. It's not even compulsory, it is there. If it is there, fine. If it is not, it is fine. Okay, let's go back. Now, like I said here, that's the signal. What is the signal to use capital asset pricing model? Beta. What is the signal to use dividend model? It is dividend or any other item from P or L, or not any other, so some items from P or L. All right. Then Miller and Modigliani, what are you going to see? See cost here. So this one is beta. Here you will see dividend or P or L info. Okay, then I said for Miller and Modigliani, you are going to see cost of equity of a geared company, or you see WACC of a geared company. And most times you'll be supplied for proxies, information about proxy. Okay, very well. Let us look at this question. ICAN May 2016, question 1. What is it saying? May 2016.
May 2016.
Yeah, question 1.
1 second. Question 1, Abi.
Yes.
May 2016, Abi.
Yes.
Okay. Katam. Pi.
Yes. 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 Okay. Yes. Go on.
Okay. Akampai has adopted a strategy of diversification into many different industries in order to reduce risk of company shareholders. This has resulted in frequent changes in the company's gearing level
Mhm.
and widely fluctuating risk of individual investment. Presently, the company has a target debt to asset ratio of, that is D um, divided by E plus D of 255, and an equity beta of 2.25, and a pre-tax cost of debt of 5%. On on January 1st, 2016, Catam PLC, with a year end of December 31st, is considering the purchase of a new machine costing 750 million naira, which will enable it to diversify into a new line of business. The new business will generate sales of 522.50 million in the first year, growing at 4.5% per annum. A constant contribution margin ratio of 40% CAB to CAB. Okay, 40% can be expected.
Yeah.
Can be expected throughout the 15 years life of the project.
Okay.
Incremental fixed cash cost will be 84.32 million naira into the first year, growing by 5.4% per annum. A
Okay.
regional development bank has offered a 10 years loan of 3% to finance 40% of the cost of machine. The
Okay.
balance of 60% will be financed equally by a 10 years commercial loan with, with annual interest of 5% and a fresh round of equity. The issue cost of the commercial loan will be 1%, and the new equity will incur issue cost of 3%. All issue
Okay.
costs are on the gross amounts raised for the respective capital. Issue
Okay.
costs on debt are allowed to tax purposes.
Okay.
A firm that is already in the business of a new project has a gearing ratio of 20%, debt
Yeah.
to assets, and a cost of equity of 18.1%. Its
Okay.
corporate debt is risk-free, with tax
Okay.
rates 30% payable in
Okay.
in the year the profit is paid. Tax depreciation of 20% on cost is available on the new machine. Katampai has weighted average cost of capital of 15%
Okay.
and cost of equity of 17.5%. The
Okay.
risk-free rate is 4% and the market risk premium is 7%.
Okay. Require.
You are required to estimate the adjusted present value (APV) and
Okay.
advise whether the project should be accepted.
Okay.
B.
Very good.
Explain the circumstance under which the use of APV is appropriate and the major advantage and limitation of the use of the APV method.
Okay. Good. Thank you very much. So we are going to do question A, but we are not doing everything now. Now, we are going to get to APV very soon. Because of this question now, I will make sure that the next topic we are going to treat after cost of capital is investment appraisal. This is a pure investment appraisal APV thing, but I want to, cost of capital is inside this question. A cost of capital is needed. Hmm?
Mhm.
The cost of capital that is needed, we are going to calculate it using Miller Modigliani. Why? Go back to the story and read second to the last paragraph again. And please, just, okay, it's possible I think if you are using soft copy, you are reading soft copy, you don't have paper. I just want you
The,
to take note of this question and the paragraph, second to the last paragraph. Go on again.
Okay. Okay. A firm is that is already in the business of a new project has
Yeah.
a gearing ratio. Hmm,
Gearing ratio of 20%. Yeah.
yeah, debt to assets and the cost of equity of 18.1%. Its corporate debt is risk free.
Good. Thank
Then
you.
the, yeah, then the
Good. What
tax
do
rate.
no, 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 no. There's only that's all. That's all. It's just
Okay,
seconds.
that's all.
So what? So
Okay,
what do you think is happening in this paragraph you just read?
that means it does not really have debt.
Mm, it does. Debt to equity, debt to asset is 20%. You know what? Do you know it is investment appraisal, abi? Project
Mhm.
appraisal? Do you
Yes.
think they want to diversify?
Mm,
Is that diversifying? They want to diversify, and it's a
yes.
new thing. So examiner is giving us information about proxy. Can you see it?
Yes.
A firm, a firm that's already new in the business. Abi, that's a
Mm-hmm.
proxy. Do you understand?
Mm-hmm.
So we are supposed to calculate something that represents business risk. From where we are coming from, when they give us proxy, they give us beta equity of the proxy. Do you remember?
Yeah.
But this time around, they gave us cost of equity of the proxy. And the proxy is a geared company. How did I know the proxy is a geared company? The proxy has a gearing ratio of
Of
20%.
20%. Yeah.
So that's
Yeah.
how I know that the proxy is a geared company. So let us do it as if we want to calculate project. We are actually calculating project specific cost of capital. Step one is proxy.
Mm-hmm.
We are using M&M. Now, what do you have in proxy? Cost of equity geared is 18.1%, right? So the proxy is a geared company. So that cost of equity is cost of equity geared. What else do we have? Market value of equity. Market value of equity is going to be 80% since market value of debt relatively is 20%.
Okay.
Do you understand this gearing? They said gearing ratio of 20% in brackets, debt to assets. Do you
Debt to
understand?
assets. Yes. 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 Yes.
Yeah, so we have talked about it
Because
before. So it means,
it's just like if it's 20%, 100 minus 20, that would give you 80 to give you this.
thank you. Thank you.
All right. Okay.
Because
Yeah.
since as asset is the denominator, debt and equity
Yeah.
makes up assets. And
Assets.
debt has
Yes.
already nice. Debt has already take 20%. Well, equity is 80. Good. So
Mhm.
now remember what I said. The information you have will determine what you're going to do. They gave us, we cannot use capping here because we don't have beta.
Okay.
We can't use dividend model. We don't have
That's,
Gordon or whatever dividend that we need to use.
yeah.
So it is Miller and Modigliani we are going to use since we have cost of equity geared. Now, so now using Miller and Modigliani, step two, using M and M proposition 2 to calculate cost of equity ungeared. This cost of equity ungeared will give you business risk. Remember, this is the cost of equity of a company that is not geared. So it
Mhm.
is going to, yeah, it is going to help you to estimate business, um, excuse me, business risk. Okay. it is exactly like beta assets. It's doing the same job with beta asset, but it's just that beta asset is speaking for capping. This one is speaking for Miller and Modigliani. Now, what is the proposition 2? The formula would be, if you scroll down, go to the formula page, you will see the formula for proposition 2 there that I wrote out initially. You see the formula for proposition 2. Have you seen it? M&M.
Yes. KEG. Yes, yes, that's in it. Okay.
Good. That's the first formula, am I right?
Yeah.
Good. KEG equals to KEU plus
EU
KE
plus KU
minus
minus KD.
KD VD
V.
divided by VE, then
Mhm.
1 minus T. So that is the formula. Now, what are we going to have? Our cost of equity geared is 18%. So let me have it here. So KEG is 18%, 18.1%, sorry. It is equal to KEU, Abi, plus
Mhm.
KEU minus KD. What is going to be the KD? Since examiner already said the debt of this company is risk-free. The depth
Mhm.
of the depth of proxy is what? It is
Risk
risk-free.
free.
So we are free to use risk-free rate as the cost of debt of proxy, which is
Okay, which is 4%. Yeah.
4%. So what is the value of debt of this proxy? It is 20. Value of equity is 80. 1 minus tax. What is tax rate?
Tax is
20%.
20. Yeah, 2%.
Good. Let me punch your calculator what you have. Now,
Okay.
this is how, please, you first of all expand the bracket. This is how you punch it. 1 minus 0.2 is 0.8. So 0.8 times 20 divided by 80. What do you have?
This is 0.8 times 16 divided by 8. That
Yeah.
is 0.2
So
for
you have,
15.1 equals KE plus
yeah. So 0.2 multiplied by 4.
0.2 times 4. That is
Okay.
0.8.
Okay. Uh, Hold on, please. 0.8 times, let's see, divided by, okay. Now, proxy, I'm coming. Debt is risk free. Okay, so 0.2 times 4, say that's 0.8. 0.2 times KEU, that is 0.2 KEU. Okay, so we have been able to expand the bracket. Okay, now plus KEU equal to 18.1. 18.1. So, we can write it like this: 18.1 equals to
plus
1.2 KEU. Do you agree?
well, that's it.
This is
uh,
just some maths
yeah,
minus
yes, we
0.6.
can. Yes, we
Yeah, it
can.
can go ahead. So,
Yes,
so,
because
so yeah,
KU, you just adding KU plus KU will give you like
yeah,
one, basically.
yes, exactly. Yes, yes. So,
Maths, why must it be maths? Inside, I thought I
eh,
ran away from mathematics.
what did you say?
I told me I ran away from mathematics. So.
Just mathematics here you come again. Okay. So, so it will now be KEU will now be equal to, it will now be 18.1 plus 0.8 divided by 1.2, right? So KEU is equal to what?
Give us, that'll give us 15.75.
15.75.
Yeah.
Now, 15.75, that's our answer, approximately 16%.
Mhm.
Just nearest number, 16%. Now, this is the way Miller-Modigliani formula will work. We can use Miller-Modigliani proposition 3 as well. That one is talking about work. Now, look at it. Remember that I have already said, work of an ungeared company, it is equal to the KEU of ungeared company. Do you remember?
Yes, we said that.
Good. Let us try it now. So if you want to do work, all right, in provision 3, work of geared, it is equal to work of ungeared. We are looking for work of an ungeared. 1 minus debt times tax divided by value of equity plus value of debt. So what is the work of geared? Let us calculate it. Work of geared is equals to, what is the KE? KE is 10.81, Abi. Value
Mhm.
of equity is going to be 80 divided by 100. Debt. Debt is risk-free. That is 4%. All right. The cost of debt of the proxy, 4%. I want to calculate the work of the proxy. Then debt times tax, 1 minus 0.2 divided by 100. So what is the work? This is 80 divided by 100 times 18.1. This is 14.48. We say 8 times 20 divided by 100 times 4, 0.64 plus 14.48. We have 15.12. Approximately, my calculator,
Let me calculate this thing. This is eight. That's like 0.8 times 0.1 times 0.8.
8 divided by k times 18.1.
Divided by 100 times 4. So 0.64